but it will depend on what is the risk all about. So us as decision makers, we should also think about that when we're talking about risk and uncertainty. Again, a decision tree. Do we know it? Decision tree? And in good. Mona, decision tree? Yes. Right. Decision tree is something where you have, let's say, so many things that are there where you are going to make a decision. For example, we can think about, let's say, we want to make what? Think about any product. Samosa still. Okay, we are making samosa. We are making samosa. We want to go and sell it where? City center. We're selling at city center. Okay. So, are we going to buy or we are going to make? Mona, are we going to make or buy? Make. Good. So we are going to make samosa. Samosa, who is going to make? Is it yourself or somebody? Mona? Yourself or we are going to employ somebody? Yourself. Okay. So we are saying you are making. Then maybe we think of you, let's say, buying at a shop, whatever commodities, okay? Buying of material, then after that you come maybe and make at home, make. Then after that, are you going to sell it yourself? How many people do you want to send to city center? 2. So we're saying after making, we have John and Mary that are going to go to city center to sell. Then after selling, they are going to sell to city center. Okay. Then are they going to use bus or footing? They will walk. Okay. All of them are going to walk? Come again, bus. Okay. So all of them will go by bus. Go by bus. Then they go to city center. It's just for you to understand what I mean. When we're talking about decision tree, it's the way how you are going to have that. And sometimes you can also include problems that you face. Okay? You go and Google decision tree. It's a good one. In fact, I'm afraid that you have never interacted with this subject. It's in accounting, statistics. Don't you interact with decision tree, Mona? Only the statistics, is it? Yeah, you're okay. Because you're a university student, please Google decision tree. Next week, we discuss about it. You come and present about decision tree. Yes, about decision tree. Okay, Mona, don't forget, unfortunately, the one that reminds us today has not come. Anthony, are you going to be continuing coming to class? Please, next week, first thing, before we start another topic, we are going to discuss, you are going to present, all of you, about the decision tree. Is it? Good, good. So that's the first thing that we are going to do before we tackle our normal class. So you as a management accountant, you're supposed to make sometimes a decision tree for you to show the risks and uncertainties that are there um, between what you want to do, and then make a decision on what you can do. So there are so many ways that we can think when we're talking about risks. You look into the opportunities when you are doing something in your decision making, when you are thinking about, let's say, buy or make in in accounting. You also have to look into that to say what are the opportunities that are there, and then maximize that, and then minimize what is not an opportunity. Come again? Yes, we can think of that, because you are going to compare the expenses that are involved. Yes. So you say, because of the scarce resources, then I should do this than this. So we can think about that, sure. Yeah, so we have said that a risk is a potential problem. It might happen and it might not. Risk concerns future happening, and risk involves change in mind, opinion, actions, places, etc. So risk involves choice and the uncertainty that can be there. So when we're talking about decision-making techniques, are those. So what have we said that pricing decisions are? Because time is not with us. Pricing decisions. Come again? Pricing decisions. Pricing decisions, what do we consider? We consider those. Also, we also think about the internal and external customers. Okay. We have internal customers as well as external customers. And what we have already written on the board. Good. So we have talked too much on buy and make, and then risk and uncertainties. I think for today we just have to stop there, because then the presentation goes as far as budgeting, which is another topic next week after presentation of decision tree. Is it? Good. So I think what we can do is we just have to break a bit for the 12 o'clock class that we're supposed to start at lunch hour, then start with the reporting, is it? Yes. So you can go and have your water, then 12 o'clock come for the Richard, Mona, come here. You didn't write the subject. Take your pen there. Subject you didn't write. But your room is the same? Yeah. Okay. Kodi ujeni. Mona umakhala kubodi. Ukapena umachoka kunyumba. Umakhala ubambile. Financial reporting. Financial reporting. Maybe before we go there, we should also do a bit of revision, is it? Maybe the revision should come later when our friends have all done that, because it will need writing. So we just have to continue with what we are going to continue today. The first question that we're having is, when do we recognize revenue? That's what we're supposed to learn. It's not something to do with the vision. Be after your meal, that's when we're going to continue the writing. But this is the topic that we're starting now. Um, when do we recognize revenue? Maybe before we go ahead, what is revenue? What is revenue? Revenue. Revenue is sales. That's it. Anthony, Anthony, this time you have not come for school. I'm telling you. You are not the Anton I know. If we talk of profit and loss, see, that's what we talk about revenue. That's the first entry we should have in the profit and loss, isn't it? Yes. So I'm afraid to say Anthony doesn't know revenue. Imagine, then you are not an accountant. So sales, but in the normal way we can say sales minus. Isn't it? That's normally what we say, is it? So revenue is that. Um, revenue. When do we recognize revenue? When do we say this is revenue? When do we recognize revenue? Revenue recognition. When do we recognize revenue? When do we say that this is revenue? When we have done sales, that's when we recognize revenue. That's the first one. The other one, where can we say we have recognized the revenue? Come again? After collection of tax. For example, can you explain? Or you mean do the same things, then we should also subtract tax? That's what you say? We only recognize when we are so selling, that's all. We don't have other ways where we recognize revenue. How about when we have added value to a product? Don't we think that's another way of recognition of revenue? How do you look at that? For example, where we can think about, let's say, you are in a rent. Does it mean rent? They have just painted the house. They say, please, can you top up on the, it was only 50,000, now it's at 70,000. Is that not also the other way of recognizing revenue? How do we? There we are talking about the revenue recognition when we are selling. After subtracting the amount that is still in stock and then minus tax, as I said. Okay, that's the recognition that we're talking in general. Okay, but we also have other ways that we can recognize revenue. So they want us to discuss those ways that we can say this is revenue.
So, for example, the one that we have just mentioned is on the rent. Is it addition on the, I don't know how it can be stated, for example, under revenue.
No, what they can, you can state. We can, let's say, go back to the profit and loss that we can do, or we can go back to balance sheet. Okay, we have added, let's say, a truck. Okay, a truck, or we have added, let's say, we have bought something, a trailer that is supposed to be, which means the value of the asset is no more the same, isn't it? It has been added, isn't it? So they want us to understand when we recognize revenues in normal circumstances, because we are reporters. We are reporters. You know, value addition to an asset is also revenue recognition. How do you look at that? Is it not like that? Anton, how do you look at that? In the normal circumstances, nyumba akapenta or apangirako chipinda china, obviously mtengo uta. Yes, but we are talking into not just thinking about kukweza, but when they have done something on an asset, on something. So obviously it means that is another thing that we can think about when we are talking about addition of revenue, because it's not going to be the same as according to what it is. So in the normal way, we are supposed to think about those lines as reporters. We are supposed to know how we can know that this is revenue, that it has to go to this financial statement. Because what we are reporting is always, you have to think about the financial statements that we report when we are using accounting ways. So we as accountants have to know which ones are the revenue that we should put to revenue. Maybe we should go back to the profit and loss that we had seen last time to see which ones went into the content of revenue. Because revenue recognition is something that we should also know that is important to us. That's why they're asking such questions. When do we recognize revenue? When do we recognize revenue? In the normal way, when we are saying recognition of revenue, there are so many things that we can say. These are the ways of recognizing revenue. In our book, I think we have some ways that they have indicated where they are comparing to say, when you have, let me do this. revenue recognition. We just have to take a building, okay? A building. For example, which building can we take that it is there, or a vehicle? A vehicle. A building, we start with a building. Building, we have added the another compartment of the house, is it? We have added, let's say, a room. It means increase in the asset itself, is it? The asset, it means the value has gone up. But the same building has not been added a room, but it has just been painted. The value of the asset is not there, but it has been painted, which means these are just the expenses. So you have increased just the look of the what? Of the asset. While when you have added the room, it means you have added the value of the asset. Whereby, when we have added the value of the asset, this one still goes to the what? Balance sheet. How about painting? It goes to profit and loss, is it? See, there are expenses. Okay, is it? What if, let's say, we have a vehicle now? We have added a what? That we are picking some when we are going to the lake. What is it? A bogey. What's a bogey? Bog. I don't know. I don't know whether it's a bog, something like that. But the other thing that we have made, this is addition to the asset, increase of asset, is it? The same vehicle, okay, the same vehicle which is parked there has been now taken to the road for us to be making something out of that. Or else you paint it for it to be attractive for more money making. Maybe we can think of another example. Then this is where you talk about revenue. You get the point?
So the time you have painted it,
yes,
that's when you recognize revenue.
Yes, we have changed something, but not changing, adding value. Okay? Okay? You have painted the room like this one. We are already running in it. We are already learning in it. You have added something, but not value of the asset. That is where we recognize revenue. That's what they mean. We have so many ways, but these are some of the ways that we should think about how or when do we recognize revenue. We recognize revenue when we have just changed the asset, not adding value, but we have just made it to be better than it used to be. Because you are reporters. As you are reporters, you are supposed to report the exact things that, in fact, in normal ways, it was, when was that? I think it was another class. We discussed at length because they were saying, in normal ways, these do not happen. Do we do that? Can we report that? For example, we are discussing about when we are reporting, we have bought an asset. We have bought an asset, transportation of the asset to the point of use, and then even the one that is installing the asset, all that cost should go to the asset value. But do we do that? We normally don't do that, but this is what they are telling us, that we should do that. The asset, when you are installing the asset, every expense before its use, all that should be taken to the asset value. But can management accept that? We have bought, let's say, a vehicle at 25 million, and you say, no, because, or a machine at 25 million, and then somebody comes to install it. That amount, according to reporting, it's supposed to go to the value of the machine itself. I remember when we were installing this, I was in the office there. I said, no. The amount of installing and the amount that we have bought this for are supposed to be the value. They refused. They said, no. Why should it be like that? But our books tell us that as reporters.
And that restoration is part of the asset.
Exactly, before use. Okay, before use. So there are other things that we learn, but in physical, in normal, we have taken it as a norm that this cannot be like this. You get the point? This cannot be like that. So this is exactly the same with what we are learning today. To say there are some things that we don't understand, to say, but how can it be? We have just changed, let's say, the room that we are learning in. We have not added any room, because addition to the value or something to there, it means you are changing the asset value. But we are talking of just renovating it. Okay, renovating it. So those are some of the things that we are supposed to think about when we are talking about revenue recognition. So revenue recognition to us is something that is very, very important, because how are we going to record in our books of accounts? That's the first question that we are given when we are talking about revenue recognition. What amounts are recorded as revenue? That's the second question. What amounts are recorded as revenue? On the first question, when is revenue recognized? You haven't taken anything. Okay. We're saying when an asset has been added, tikawonjezera kukula kwa chintu, olo galimoto tiikako mwina trailer. Okay, pamene paja value asset is raised. Okay, but sometimes we're not just happy that that car, its paint has gone. We want to paint it so that it should look beautiful. Okay, that's when we recognize revenue. This room, when we can say gumulani apa apangeso chipinda china, that's something different. But when we're talking of revenue, let it be painted. I think when we are going to read the presentation, you are going to like it, to say, okay, we understand. But in normal terms, maybe you can't think about that. But when we're talking about reporting, this is what happens. When you have painted the room, it's a class normally that we use it for revenue correction that we are teaching yourself. Okay? If we say we should make another compartment that's changing the value or the looking of the building itself, that's asset value increase. But we're talking of just painting it for you to be sitting in class, just to feel good that we're in a good class. That's where we should think about revenue recognition, because we are putting you in a good environment according to what they think themselves. So that's where we're saying revenue can be recognized when you have done that, but not when you have done that. When you have done that, and then when you have done that. When do we put the revenue or expenses? When we have done something, let's say, just to make it better than it used to. But when we have added something to the asset, that's when we talk of asset increase.
Okay, like you paint your car,
Mhm.
or you paint, or you build a house, you can make money. That's when
You recognize that as revenue, but not when you say add another let's say a bedroom. That it means it's the addition to the value of the asset. Obviously, balance sheet is going to have an increased amount because you have added something on it. Anthony, it's fine. Next time I'll ask the same questions and then you fail. But that's what it means. It's nothing apart from that. We just have to know that when you are just renovating the asset or the rooms, it means that's the recognition of revenue. While when you are adding, you are changing this the look of the asset itself, it means you are increasing the asset value, whereby the balance sheet is what is going to change. Then I was going to the next question. Then I was told by Dorothy that go back. Should we go to the other? What amounts are recorded as revenue? Yes, they just want us to listen to imagine as we have done there. As we have done there. For example, the value of our building was 100 million. Okay. The value of our vehicle was 30 million. But when we talk of adding another room, the room that we have added is about, let's say, 3 million. When painting, we painted with 500,000. And then a vehicle, a bug, we bought at 5 million. And then painting the car itself took us 1 million. We just want to understand what they mean when they are saying, how do we, amounts that are recognized in revenue, the second revenue recognition. We're saying what amounts are recorded as revenue. As revenue. So it means when we are talking about the two expenses, it means we are saying that when we're talking about building, what goes to the balance sheet? Which amount goes to the balance sheet? The 30, the 100 for the building, then vehicle, the 30 million. How about when we have done something like that to each? The painting, which is how much? The 500,000. Building vehicle. That's 100 million, 30 million. The 500 goes to the profit and loss. This is the 500 painting. 500,000. How about this one? The 3 million. Anton. Profit and loss as what?
3 million goes to balance sheet because it's an addition to the asset.
We have added value to the asset. Therefore, it will be plus 3. While here it will be plus what? 1 million, is it? No. 5 million. This one goes to the. That's what they mean. To say how should we recognize revenue? Apart from the revenue we already know, there are other revenues that are there that we should also note that they should also be recorded. They should be reported in the books of accounts. I don't know, maybe we should go back to the book where we had the profit and loss and then balance sheet. Maybe we can appreciate on that. This is presentation of financial statement.
For me, it's fine even if we don't go back
Is
to
it?
the exam.
It's fine. No, do you have a book yourself there? Then that's the problem. Phone yake. Phone yake. So sometimes when we are home, we can always go back and see to say, okay, this is what they mean, this is what they record. Because sometimes we just look at whatever is there, not knowing what is happening. Why are we given this topic? They want us to know which ones we should record as revenue and which ones we should not. Because we can't know. In normal terms, you can't think about that. We just say, these are just the expenses, isn't it? They're just the expenses that we are doing. So this is what we want to understand when we're talking about revenue recognition. We have the third one, which is the forms of sales growth, internally generated growth, and the growth from acquisition. Growth from acquisition. So what they want to tell us is exactly what we were saying to say. When we are recording something that we have bought, it means we're supposed to know when we should record it. We have acquired an asset, and then what should we do? So it's just the same that we have learned shortly in this subtopic that we're talking about. We have the normal sales that are there. So this is what they want to tell us in connection of revenue recognition. Then we have the third one, which is the long-lived assets. What are long-lived assets? Long-lived assets. What are long-lived assets? Long-lived assets, the name itself can tell. Yes, that's it. Assets that live long. For example, land. Good. Anton? Yes. Come again? Buildings. Mona? Machinery. Good. So these are some of the assets that we can think about them being long-lived assets. Long-lived assets. How about intangible assets? Do we have anything that we can put them in long-lived assets? Come again, say it loud so that our friends should also have the consumption. Goodwill, yes. Okay. Goodwill is also in the long-lived assets. It can't just cease today. It's there for long periods. And when should we say that this is a long-lived asset? How should we describe it? How should we describe it? Long-lived asset? Yes. More than 1 year. Yes. The other thing. Where they can have a value, isn't it? Yes, a big value. So that's that when we're talking about um, long-lived assets. There are so many things anyway in connection of long-lived assets. We have them having a useful life, is it? Is it useful? It goes when um, which you can depreciate, but it's not, of course, no, not all assets that depreciate, is it? Which doesn't? Which asset does not? Land. Land does what? Appreciate. In another class, we had an argument on that to say, but sometimes it depreciates. So somebody said, how? When it's being mined, when they're making mines out of the land, it depreciates. So that is another thing that I learned anyway, but normally land does not. Which has got useful life, which can be used for more than a year, is it? More than 1 year? Depreciation involved? Where there's again there is a measurement of fair value. We have already said that, is it? No, we have not. Where it has value. You cannot talk about an asset without value, possible. So those are some of the things that we should know when we are talking about intangible, long-lived assets. They have depreciation involved. Yes, so if useful life, they can be disposed, is it? Can also be disposed. Of course, goodwill, as we have already said, is an intangible asset, but also long-lived. Tangible and intangible, is it? All these can be long-lived. Where we are saying intangible goodwill can be there on intangible asset. So intangible assets also, we can discuss them, that they have other features that we can also think about. The tangible ones are the ones we mentioned, that obviously you can think about them being there in the company, and this is where most companies rely to say we are going to give them a loan because of what they have. And that's where they say, yes, it is a company that even if it doesn't give us the amount, we are going to pick one of or some of the assets that it has, then we recover our monies. So long-lived assets are very, very important if we are talking about them being in the company, when we are talking about the company or lending organizations that are involved. So this is important. Again, of course, we have already gone up to long-lived, but on revenue recognition, again, research and development also can have something to do with the revenue recognition when we're talking about, let's say we are developing something, a research is being done, then when we have done something about the research, and then we have now started recovering the monies, there again, we can recognize the revenue when it is there. So intangible assets, when we're talking about intangible assets in connection of the topic we have, we can say intangible assets are assets which we can not touch, but are there for us. And then we can say that it is recognized by the entity, and the International Accounting Standard 38 is the one that talks about intangible assets, where an entity expects future economic benefit. So always when we're talking about the asset, we should also think about economic benefit of any asset that we are talking about, whether intangible or tangible. So we have intangible assets like the goodwill, computer software, patents, copyrights, motion pictures, film, customer list, franchises, fishing rights, and so many. These are some of the examples on intangible assets. An intangible asset must be identifiable in order to distinguish it from goodwill. Where it has to have non-physical items, there are many to be problem with the identifiability, but it shouldn't be goodwill. When an intangible asset has been acquired separately through purchase, there are many things that we can talk about. The transfer of legal rights that would help to make an asset identifiable. For example, if we're talking about goodwill, it means when you have changed maybe business, or somebody is buying your business, it means you also have to change legal rights because it's an asset that we are supposed to recognize it. So us as reporters, these are some of the things that we should know, that we should recognize the asset by changing the legal rights to be in another person's name. An intangible asset may be identifiable if it is separable, if it could be rented or sold separately. However, separability is not an essential feature of an intangible asset. Despite it's also part of the explanation, but that's not the feature of it to be an intangible asset. But an intangible asset has to be controlled by the entity. Another one feature of intangible assets is controlled by the entity. That's the first recognition that we should know that this one is an intangible asset that we should talk about in the entity. So another element of the definition of an intangible asset is that it must be under the control of the entity as a result of the past event. The entity must therefore be able to enjoy the future economic benefit of this asset and prevent the access of others to those benefits. A legally enforceable right is the evidence of such control, but it is always